Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. This weekend, Berkshire Hathaway had its annual meeting, and I had a chance to sit down and watch the Q&A. I have been to the meeting before. I only live a couple hours away, but I find sometimes it's easier just to watch it on television than to actually go because there's so many. Everybody should, I think, go at least once. But, people travel from all over the world to come to the meeting, and I feel like, I'm just a little bit spoiled. I don't need to be taking up a seat for the people that really want to come. So I usually just watch on television. So this video is going to be just some of my takeaways, my thoughts. Usually I have unique views on at least a few things. And so these aren't necessarily going to be quotes or anything. This is going to be my take, my read through overall from what we learned from the meeting and the Q&A. Because a lot of times, well, actually, this goes into the theme, actually, of the Warren's always been, he's never really talked too much about real investing, like strategy and what he's doing, because, he doesn't want to give away his secrets to everybody, and because it would make it hard for him to find investments to some degree. So you do have to do some reading through, and he's also not going to criticize or do anything that he thinks would hurt Berkshire, which I think plays into this. Warren used to share his political views, carefully but freely, I would say, until the past few years, where he kind of got to the point where he felt like he wouldn't be damaged by what people thought or any kind of reaction to what he had to say politically, but that it could come back and hurt Berkshire, and he didn't want Berkshire shareholders to be damaged by some political view that he had. I would say he's gotten very quiet on most domestic political issues, especially if it's a hot button issue, and so you have to be willing to kind of read through some of this. So my biggest takeaway from the meeting is that Warren is defensive. He's in defensive mode right now. And he's lived through a lot, so I think he is probably aware of dangers more so, the big dangers more so than, the average person, the average investor. One political thing that did come up were the utilities out west and the wildfires and the potential liability from those, where really the message that's being sent is, if regulations don't change and the legal posture doesn't change, then utilities are not going to be investable and by private industries because the risks are going to be too high. It's really just letting politicians know, I think mostly, and regulators know that if they want private capital to help fund electricity projects, then and other projects like that, then you can't have the same some of the regulations that we have now, or they can't be interpreted the way that they are now in Oregon and California in particular. So without completely saying that, that is just what has been said. And then he held up Utah as an example, or maybe it was Greg, of a state that seems to be kind of doing it right. But again, this is a defensive thing. If you read the annual letter, he talked about it there. It was really more about the risk that's associated with that business, and it's due to politics. And, climate change, they say, but there's always been wildfires. There's always been these things, but the reaction of regulators and politicians and lawmakers and society, frankly, was just different. So it's changed. That's the only local political thing I think that really came up other than taxes. But the big picture here is really geopolitics. And you can see he had direct questions about investing in China and Hong Kong. He basically said he's going to mostly be investing in America. And because he understands the culture here, the weaknesses and the strengths, I think is what he said. And so he doesn't necessarily understand those in other places around the world necessarily. It doesn't mean he won't make investments, I think, but and at one point he said, something like, if you've watched, what's going on in the world, basically, is geopolitical risk is very high right now. And Apple has exposure to China in terms of their manufacturing and in terms of their sales. And I think that's probably the primary reason he's been selling some Apple stock. I don't know if they sold all of BYD, but they sold a lot of it already. They sold out of Taiwan Semiconductor. They're trying to reduce their exposure to China, which is something I've talked about on this channel. It's for investors since I relaunched basically last October. So Warren is cautious on the geopolitical front. I think he's also cautious on the domestic political front. And as we've seen, there's just a lot of division in the country. And we have an election year. He focused a lot on making the case that Berkshire is an asset to the country and willing to pay, that it pays its fair share, certainly, and is willing to even pay more for the benefits that come along with being in America. So again, trying to make the case that Berkshire is going to be an asset for the country, and hopefully whoever's in charge understands that it's better to have Berkshire as a partner, as a business, whether it's whoever's in charge for the country, than it is to kind of come after Berkshire in some way, whether it just be through regulations or job owning, whatever. I mean, I think he's trying to get in front of, and he's been doing this for a couple of years. He's been trying to get in front of, I don't even know, it's not like a particular, it could be, it's, politics is strange. I mean, I have a master's degree in political science, and so I've studied politics a lot, and I think it's hard to predict what groups of people will do when they get a little crazy sometimes. And it's not limited to one particular group of people. It could kind of come out of nowhere. And if the fever gets hot enough, people can do dumb things, and governments can do dumb things. And so I think he's trying for Berkshire to be quiet and point out ahead of time the contributions that the business makes to the country overall. And then, so I think honestly, and he has, like 20, I think a little over 20% cash in Berkshire, which is what he's had, which is what I've kind of been watching. I think it might be tipping a little more than 20% of the market cap now, because they're getting close. I think the market cap's like, well, let's look. Market cap's 864 billion, and they had like 190-ish in cash. So I think when I did the math on that, it was like 21 or 22%. But those are just rough, estimates. So he's still at that 80% equity, kind of 20% cash, but he feels very comfortable with the cash. Feels comfortable. I think it's more about reducing the risk, with the Apple sales. The other thing is, he talked a lot about, again, and this is making the case for Berkshire again, and Berkshire shareholders, about the shareholders who were donating their shares to some philanthropic organization to try to, benefit. One of the Berkshire shareholders donated like $1 billion to the Albert Einstein Medical School, so that students could go there tuition free. And he said there was another $500 million Berkshire kind of donation that same day that was anonymous that went somewhere else to a different organization. And Berkshire bought back, it sounded to me like when I was listening that Berkshire bought back those shares from the institutions, so the institutions have the money and Berkshire bought those shares and I assume retired them. This is actually what I wrote an article in 2018 about how, because that's when Berkshire started their buyback program, and I said it made a good idea. And I don't think anybody else, I will give myself a little bit of credit. I don't write too many Berkshire Hathaway articles or make videos because I have so much respect for Warren and Charlie and everybody at Berkshire. And I think that they get misinterpreted a lot and they can kind of speak for themselves to some degree. But sometimes I think they can't. And, it's nice to just, if I see something, then I'll write about it. So this was the first Berkshire article I ever wrote. And it was I think the most important part about it was just showing how Berkshire was donating. I'm going to go a little bit from memory here. I think they were donating 15 million shares a year to the Gates Foundation, and the Gates Foundation was selling like 20 million, so slowly reducing by like 5 million shares a year the Berkshire donations that were going in total. And if you looked, like that's about the same amount of shares Berkshire Hathaway was buying back. So we've seen this happen before. Basically, with Buffett's money, he donates it to the Gates Foundation, so you don't have to pay like a bunch of taxes, and instead it goes directly to some organization that's trying to do some good in the world. And then so that foundation needs to sell those shares in order to actually get the cash to fund the things they want to fund, and so that the stock price didn't get beaten down for probably a decade or so as Warren's shares hit the market. Berkshire was just buying those shares back from the charity, which is exactly, it sounds like what they did with these two big donations, which is good because, one, they have the cash to do it, and two, it means that smaller people who aren't billionaires, aren't the billionaire shareholders of Berkshire, can if they need to sell Berkshire stock to fund their own retirement or whatever, they can do that without the price of Berkshire shares being kind of artificially low. So it's a way to make it fair, which I think is really kind of thoughtful on Warren's part, to make it fair for people who really do need that Berkshire money to live off of in retirement or whatever, and because Berkshire doesn't pay a dividend. And so I thought that was a good way to do that. And he has mentioned a couple times since then that there aren't too many Berkshire shareholders that are like that most of them have plenty of money, and that there aren't too many people he thinks that need to probably sell Berkshire to actually fund their retirement because they're all so rich. But they can, and I'm sure there are some people out there and where that's the case. And in theory, they can do that without Berkshire's share price being artificially low because of all Warren shares that are getting dumped and some of these other very large Berkshire shareholders. So I thought that was interesting that he kind of talked about that in a very positive way, which is fine. I think that's fine. There are cynics who are going to take a negative view and say, oh, this is just them avoiding paying taxes and so forth. And I think it's more about if you can direct your money to a specific area you think is more important, like educating doctors, helping the poorest people in the world with the Gates Foundation. If you have a choice between doing that or giving your money to your kids to like create some kind of dynasty, and then at the same time paying, like an inheritance tax, so you're giving money to the government to do whatever the politicians want to do with it. Given the choice between kind of those two choices, I think some people just think it makes more sense to focus it to spend it on things that you think are really important that aren't getting addressed maybe by some of these other areas. So I'm less of a cynic when it comes to the specific folks at Berkshire that are giving away their money to their foundations and to charities and so forth. So the overall big picture is, I mean, it really, I feel like Berkshire Warren is just getting really defensive. And it's been going on for a while, but he's looking out. I've talked about this with his Oxy purchase. To me, again, that's playing defense with a potential energy spike. I'm long Berkshire. I'm long Oxy as of the beginning of this year. I made a video about that. And whenever I look, that's mostly what I see are just the kind of very defensive bets. Now, other things, the Paramount thing. So I've been asked, I probably made a video or I just respond. Usually a lot of times these responses can be pretty quick for me. So I've gotten tons of questions about Paramount for the past, ever since it spiked up in 2021. So like 3 years now. And I always respond. I'm like, just go read kind of the family drama that's gone on at Paramount, CBS. I think it's CBS is what they own. Go read that, and if those are the business partners that you really want to be with, then consider it. But to me, that's just not something that I want to be involved with. I'm a little surprised that Warren took credit for buying it and losing money. That was another thing. Look, I don't follow any super investor, no matter what, basically. You always really need to think for yourself, because what they have in mind in their particular, I'll look at something that I haven't looked at. Usually it's going to be more of like a small cap idea, from like a manager who's, focuses on that. I'll go through 13F sometimes. For the type of investors that kind of do the opposite what I do, which is they'll do like really deep work on a small number of businesses. If I know they have 25% of their fund's money in a single stock, I know who they are and think that they have a logical kind of process behind what they're doing, I will definitely look at those businesses and see how they fit into what I'm doing, and if there's some overlap there. I will do it. But if there's not overlap, if it's still not a good fit, or I don't understand what it is, then I don't do it. And so that's what happened with Paramount. I just look at it and I'm like, I don't know. And let's look at it, because it's just nuts. And someone asked me about Warner Brothers, and I said the same thing. These entertainment companies are very difficult to consistently make money. They can go through periods where they make money, but it's hard. So look at this crazy spike in this stock price. So it was all the way down here. Let's see if I can get the top of it. I don't know. There we go. 700% in a year. Just stratospheric. And now we're back down here. And this is another thing from the that he mentioned in the Q&A at one point. Yeah, he was talking about Ben Graham basically, and when he first read it, when he was like, I think it was security analysis, he read it when he was like 20. Maybe it was Intelligent Investor. I don't remember which one. But he was like, I left myself a note on this, so we'll see if I can find it. But yeah, so he basically said the market is not there to instruct you, right? It's there basically to serve you as an investor, so you have a place to exchange your business shares, right? And so this is a perfect example of that. How instructive was the market when it sent this stock up 700%? It wasn't. The market was completely, absolutely bonkers. And if you took your cues from that and you're still holding the stock, I think maybe it's at an all-time low, or, pretty close. It's about down to the 2020 lows. So everybody that's bought the stock, that still owns it and didn't trade away for the past decade is now underwater. And they're almost ready, I think, to get a deal maybe finally done somewhere around this price. So, but the question is, with a stock like this, what are these assets worth? I think Warren thought he had an idea what the assets were worth. So to me, this was totally a buyout play, 100% from the very beginning for Warren. He thought he could look at Paramount's assets, figure out what those value of those assets would be worth on the market, and he probably did the math, and he probably had a number in mind of what somebody else would be willing to pay for it. And he was wrong, pretty basically. So, me, I'm just like, I don't know what the assets are worth. Like, I know I'm not smart enough to do that. So in some ways, the fact that I don't know really paid off in this situation. But it's the same for, I mean, Paramount was easier because of the family involved, but see if I can find Warner Brothers. So this one I just replied to somebody. So it looks like they're losing money here. Not a much different pattern. And to me, I'm just like, I don't know. I mean, I have no idea how much their assets are worth. I don't know how much they would be worth to anybody else. They aren't making any money. They have a bunch of debt. The business can be good sometimes, but other times, but it's not very reliable. And so I just accept that I don't know what the heck is going to happen and just kind of move on. I mean, if you bought the stock in 2007, you're down 50% now. Even if you got it on the trough here, you're probably still down. No, inflation adjusted, you're down. So could this turn around and come back? Absolutely. But I have no way to predict that. Just like I had no way to predict Paramount. Now, I did point out in that video, I do own Netflix. I do own Comcast. They are somewhat similar businesses, but also different because Netflix really dominates streaming more so than anybody else. And Comcast is mostly like cable and internet with an additional business of the entertainment side of the business and parks and things. And I have not done well. So I wasn't, let me see if I can find it, if I can type right here. So, and I bought this during the 2020 decline right there, actually. I think that's the actual day that I bought it, on the 28th. So yeah, I'm up a whopping, like 1% or 6% with dividends since then. But it hasn't performed very well. Now it's steadier than the other businesses, but they have lots of competition right now. And so I'm not sure how that's going to turn out. I thought I was getting it cheap, and I had enough margin of safety that at least I haven't lost money like everybody in Discovery and Warner Brothers and Paramount have. But it's not. And when I bought Netflix, which is, again, I think is quite different, I bought it twice. I actually picked the bottom on one of these. It just looks so cheap. I think I bought it right there. And I took profits on this one after like 100% return, and I held on to my other one for long term. But I mean, it just was cheap enough that I was willing to take a chance on it, and it's working out now because I thought that they could raise prices. To me, it was pretty simple. I was like, they can run ads, and they should be able to raise their prices, and they should be able to grow at 15% a year. And it was really that basic math. And I kind of ignored most of the other stuff that I do. And I just said, I understood this was a bust from the pandemic. You can see the boom. So I knew this bust was here, and I didn't know how bad it would be, but I knew the cause wasn't like some fundamental problem with Netflix. So between that and a little common sense, I was able to pick that one up near the bottom. So, but back to Berkshire, I think the main lesson is stay within your circle of competence. That is the same when you're investing at different places around the world. Try to understand those markets, and stay where you really feel comfortable. Also, if you look at Paramount, and you just don't feel the need to you don't have to swing at every pitch. I mean, I'm sure he said this before. I just don't feel, I want something that I can kind of understand, like Netflix's situation. I don't want something like Paramount. I don't have to value like Netflix's whole business, like when I bought it, because I don't have to know exactly what the assets are worth. I was trying to figure out how much they could grow their earnings. Like, they're just two different things. One of them I'm good at. One of them I don't have a freaking clue. And so in some ways that makes it easier, I think. And the other thing is just in terms of the risks are those global political risks and domestic regulatory risks. It's just kind of keeping your nose down and working and trying to be benefit of society as best you can, and you kind of just have to hope for the best as a business. And I think that's what Warren's trying to do. But if Warren sees trouble, I thought it was a downbeat meeting, honestly. There were definitely funding moments. The tribute to Charlie was great. But the bigger, it's just kind of be careful out there. Be careful in just about every single thing, every aspect, because we're probably in a time of significant change. I think once we get through the election in November 2025, I see 2025 as probably a very tumultuous year. Period. We'll call it period. I don't want to do like a calendar year, but it feels like we have our finger in the hole in the dam, and we're trying to keep it there until next January, and then we have to figure out what to do because we can't have the finger in there forever. And so I think holding cash, I have about, in my individual investment accounts, it's like 1/3 cash, and like 401ks is still like 45% cash. And collecting the 5.3% and looking for ideas. I'm still buying things when I find them, but if something negative really develops around the world, I want to be comfortable. I sleep well at night. I get up every day. I look for deals and wait. And I don't really have too much financial worry. I don't really have too much financially in terms of investing that I'm worried about, because I know I have the cash to deploy. I know the types of things I want to buy. I know roughly the prices I want to buy them at, and I know how to adjust them if things get worse. So yeah, like the investment part starts to become like the easy part. And I've really tried to block out the scarier things until later in this year, and just kind of enjoy the summer, keep working, and keep making videos for everybody here on the channel. So that's my takeaway from Berkshire, and probably a little bit more than that. And if you found this useful or thought-provoking or whatever, stupid, you can write that down in the comments too. And usually I respond to everybody. And until the next Berkshire meeting, I think that's about all I have to say about Berkshire. Later.